Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode of Father-Son Finance. Today we are excited to talk to you about the topic of price versus value and how the two are very different, although they are often used interchangeably.
Yeah, and actually before we roll into that topic, which is very important, it is important. Here we are. It is March of 2024, and we're celebrating 2 different anniversaries this month. Number one is the bottom of March 2009, after the great financial crisis. So this is the bottom of the market. It's March 9th, 2009. Everybody who wanted to sell has sold. Yeah. Looks like there's no hope whatsoever. Lo and behold, if you fast forward here 15 years later, we're up just over 600% since that time in 2009. So that's pretty good returns over that period, somewhere around 11.4% per year in that range for 15 years. But I promise you, nobody saw that. Nobody saw that coming in March of 2009. The other anniversary we are celebrating is it was 4 years ago this month that we all got sent home, and there was no idea of what was going to happen as COVID and the related shutdowns came across the country. But interestingly enough, on that, 4 years later, the S&P 500 is annualizing at around 25% per year. So almost up 100% since those lows just 4 years ago. And again, I promise nobody saw that coming either.
And that includes 2022.
Right. Great point. We saw a
Which
year
wasn't an easy year.
That was not a great year
in itself.
Stocks and bonds were both down double digits in that particular year.
Yeah.
But let's get to the topic of hand. I just thought we needed to acknowledge March has got some weird things that happen in it from time to time. So price versus value. So Benjamin Graham, sometimes Warren Buffett, 2 long-time godfathers of investment, often say price is what you pay, but value is what you get. And so today we're going to actually review 3 differences that we see in the financial markets as it relates to price versus value. And the first of those is that the price of a stock is not the same as the value of the company. So I'll cover this first part. The price of a stock doesn't necessarily reflect the whole value of that business. Many people think that a company that trades on an exchange for $25 a share is cheaper than one trading on that same exchange for $150 a share. Yeah. And that, right, 150 more than 25. So the cheaper one has to be 25. Yeah. But in real life, we have to look at different factors. So Walmart today trades around $60 a share, whereas Dick's Sporting Goods trades around $214 a share. And most might say that Dick's Sporting Goods is the one that's more valuable because it trades at an elevated price. However, Walmart is worth $490 billion when you multiply the number of shares outstanding times the current price. But Dick's Sporting Goods is only worth $17.4 billion.
Quite a big difference.
It's huge. So price doesn't tell the whole story. But then the second part is, I'll let you take, which one is the better value? Yeah.
So there's a lot of different measures of value, and one that is pretty standard, a generic measure used widely across the industry is the price to earnings. So that'll be the price of one share of stock versus the earnings that company has on the fiscal year. And so the two ratios for these two companies actually has Dick's Sporting Goods with a price to earnings ratio of 15.8, whereas Walmart's price to earnings ratio is 30.7. So that puts Dick's Sporting Goods actually being cheaper than Walmart, even though their stock price is higher than that of Walmart.
Right, and as a matter of fact, remember that the Dick's Sporting Goods price, depending upon the day, today is around $214 a share.
Yeah.
So that's 3 times, more than 3 times greater than Walmart's share price at $60 a share. And so you just have to be careful about this differential of price versus value. One does not tell the whole story of the other.
A very recent example of how price and value are not one and the same. Just last week, we saw Chipotle Mexican Grill have a stock split. And we can talk a little bit about what that is. So they basically, what they did was they did a 50-for-1 stock split. So for each 1 share of Chipotle that an investor owned, they now own 50 shares of Chipotle at a much lower price, at 1/50th of the price. So in their account, that investor saw the price of Chipotle shares change.
Right. Not drop, change.
But the value of those shares are still equal to what they were before the stock split. So even though the share price is different from one day to the next, the value did not change from one day to the next.
Right. So one of the most simplified ways we look at that is through, if you hand me a $1 bill and I hand you 4 quarters, did anything other than $1 change hands?
Yeah. I've got 4 items, you've got 1.
But they're both
But
worth
we
$1.
both have $1.
Yeah. So stock splits have their own unique life, and they are done for many reasons by the company to help employees be able to buy stock in the company at a more affordable price. Just as we said, Chipotle was $3,000 a share. Now it's $50 a share. Again, the value of the business didn't change, but the ease with which employees and future shareholders can buy is a lot easier. It's a lot easier to put together $50 to buy a share of something than it is to buy to put together $3,000 to buy a share of something. For the record, this is in no way a recommendation to buy any of these stocks.
Chipotle, Dick's, or Walmart.
But it's just to give you an idea of what's going on in the marketplace as it relates to some of these price versus value. So another example of a company that has never done a stock split is one that a lot of people are familiar with. It's called Berkshire Hathaway Class A voting stock. That stock today trades at over $600,000 per share, and that is unbelievably prohibitive. I mean, most people have to get a mortgage just to buy a house for $450,000, much less one share of one publicly traded company. So that's sort of the extreme example of a company that's never split their stock versus, say, a Walmart who has done probably 4 or 5 over the last 30 years. And it's just a difference in philosophy. One is not right and one is not wrong. They're just different.
They're different. And they attract different types of investors.
They do. They do indeed. So what is the most important advantage that investors have in this battle of price over value or versus value? And that answer is just simple. It's time. And so price is what the market thinks a stock is currently worth from 9:30 a.m. in the morning until 4 p.m. Eastern Standard Time each day that the markets are open. Value, however, is a determination of a stock's intrinsic worth, which is calculated through lots of different historical data over long periods of time. So both of these data sets are freely and publicly available to investors. So we know the price every day from 9:30 to 4 p.m. Eastern Standard Time. We actually know all of the components of the intrinsic value because those are released through the Securities and Exchange Commission's public portal reporting program every quarter. But how these are interpreted by investors, that's what makes markets.
Yeah, that can be very different from investor to investor and from sector to sector, depending on what you're invested in. One quote that I really like that's on this topic is, on a day-to-day basis, the stock market is a voting machine. But on a long-term basis, the stock market is a weighing machine, weighing the value. And so one day, the stock price might be voted higher or voted lower because of some piece of news. But over time, these measures of value make their way into the weighting of what the value of that stock is.
Yeah. So I always like to say too, like, there are those who know the price of everything, but the value of nothing. But moving forward here through, like, okay, so what makes the weight of a company more valuable? What moves us past price? And that is time. So both of these data sets freely, publicly available to all. That's called the efficient market theory. And that's where the theory is that all publicly available knowledge is poured into a stock, and that's why it trades at the price that it trades in. I don't know about that, but so the information that is available each day to all of us is so overwhelming that most investors don't have the time or the capacity to process all of this information in a timely manner. But what people who have been investing for years understand is that over time, a company's stock price will begin to reflect the value of the business as the earnings of that business increase over time. And so great management teams will adapt to changing conditions in the marketplace, like recessions, like expansions, like COVID-19, like the terrorist crisis of 9/11 and the recessions that followed. I think of a great company like American Express. A lot of people don't know American Express started as a company that forwarded freight in the 1850s on wooden ships. But due to their knowledge of shipping lanes, they morphed into financial and travel services in the early 1900s. And then they went on to develop the charge card in the early to mid 1950s. 1958 was the first American Express charge card. They now have one of the biggest preeminent networks of merchants and clients in the world, with a value of over $157 billion. So what was the defining characteristic of this value? It was time. It was, the fact that the revenue and the earnings continued to move higher through the years built that higher stock price. Not every company is an American Express. As a matter of fact, many companies don't even adapt to anything, and they go out of business.
So you see a company like Sears who never adapted, and they had so many different businesses under the umbrella of Sears, including Allstate and including Discover Financial.
Dean Witter.
Yeah, and so they had all of these companies that they ended up selling off, and they used those profits to put back into the department store to try to save and revive the department store that was dying and eventually went out of business, and they had nothing to show for it. So you see the juxtaposition of Sears versus American Express, which started out as a UPS or FedEx equivalent shipping freight, to now having one of the largest financial services and payments networks in the country.
In the world.
Yeah, in the world, that also allows their customers to get into the Delta Sky Club if you have the right card. And so
good.
you see the way that they adapted, American Express adapted over time versus Sears, who just refused to adapt.
And many others that we could name. I mean, there's a laundry list of companies that haven't increased their value.
Mm-hmm.
But I like to say, as we come sort of to a close here, there's only two pieces of information that you need to make any successful investment. First, what a company is worth, and what the market thinks it's worth. That's the price. And then over time, the price will gravitate towards the value, and this price appreciation is the reward for patient investors.
Yeah, and it takes time.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell, or solicitation of an offer to buy or sell any security or investment, or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company, Incorporated. Please note, past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company, Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.